Okay, and this the last slide deck for week 2. I'm going to look at amortization and depreciation. Recall that we pretty much use those interchangeably, even though amortization is the chopping up of something intangible over a period of time, and depreciation is the chopping up of something that's tangible over a period of time. Of course, I'm talking about the value, not the actual piece of equipment or whatever the case may be. So onward. All right, for a depreciation example, I'm going to assume we're going to buy a truck. Okay, and we're going to apply declining balance depreciation. And Revenue Canada allows us a rate of 30% per year on a truck. But in the first year we buy it, we only get half of that. So if we buy it in January, even though we're going to use it for 11 months, we only get to claim half of the 30% or 15%. Now, if we buy it in November or December, we still get to claim half of the depreciation, 15%, even though we might only use it for 1 or 2 months. That can have some good application depending on the amount of the purchase or the truck. Okay, so in that case, in the first year it would be $15,000. That'd be 15% of $100,000. The second year, we can claim 30% on the remaining value of the asset. Okay, on the remaining value of the asset. Now, the software I use to make the video is a little bit clunky in that it doesn't really show step by step very well for this particular slide. So I suggest pulling up the PowerPoint for this and having a run through it. So on the top right, we've got $100,000 for our truck. Over on the left, we've got year 1, and notice that we're allowed 15% depreciation rate on that, which turns into $15,000 in cash. Next column, we've got accumulated depreciation. So in the first year, we've only accumulated $15,000. The value of the truck, the leftovers or the book value of whatever term you use, is $85,000. And I prefer to use book value. That's a fairly common term and fairly understandable. Okay, the truck might be worth more or less than $85,000, but if we go by the book value, this is what Revenue Canada uses, it'd be a little simpler to think about. Okay, so if we slide down to year 2, our rate that we're allowed in year 2 is a full 30%. Now the amount of expense is $25,500. Well, where did that number come from? Well, we're allowed to depreciate the book value. Okay, so we take the 85,000, not the 100,000. We take the 85,000, multiply it by 30%, and we get 25,500. Okay, so that's our expense. That shows up on the income statement. Now, to keep things all balanced and everything, we accumulate the depreciation year after year on the truck. So we add 15,000 to 25,500, and our accumulated depreciation is 40,500. Okay, and that shows up on the balance sheet. So our book value is 100,000 minus 40,500, which gives us a book value of 59,500. Okay, going to go through year 3, same idea. Year 3, 30%, amount expense is 17,850. That's 30% of the 59,500. Okay, we add that to last year's accumulated depreciation, get 58,350. Our book value has gone down to 41,650. Now, if I slide down to year 4, and I'm going to assume you get those horizontal calculations okay, I'm going to look at the ending book value of year 4. That's 29,155. Okay, it's the book value. You might be able to sell the truck for 40,000, or you might be able to only sell the truck for 20,000. Doesn't matter. We don't care. We don't worry about that in this course. It's something we do in cost accounting, not in what we're doing here, small business finance. Okay, so the book value is 29,155. So the value of the truck has been declining every year. Okay, We've depreciated it. It's been used up, expensed. If I use my definition for expense is used up, we've used up some of it every year. In year 2, 3, and 4, we've used up 30% of what was left. Okay. So if we go back to the book value or net value of the truck, 85,000 down to 29,155. Those are balances. Those are the balances of the book value of the truck, and they've been going down year after year. That, ladies and gentlemen, right there, that column is the declining balance. And because we take the depreciation from the declining balance, it's called the declining balance method. Okay. Now, just to make sure, amount expense that shows up each year on the income statement. So the first year is 15,000, then it's 25,000, 17,850, 12,495. That's on the income statement. Accumulated depreciation shows up on the balance sheet. Okay, and it's taken from the $100,000 to give us the book value at the end of year for 29,155. Now this is a slide you should really take some time with. Make sure you understand how it works, and your life will be a little bit easier. Okay. Now, in my face-to-face class, this slide pops up next, and it pretty much says it all, and I've said it all to you already, but memorize that previous example, and it'll help you a lot. Okay, assuming we've got the amortization understood, let's have a quick review of some of our terms so far. Earnings kept by the corporation from year to year. Earnings kept by the corporation. Okay, so that's our earnings after taxes or our profits, which leads to an increase in retained earnings. Okay, dividends decrease retained earnings. There's one other thing that decreases retained earnings, and that's losses. Okay, or as some people like to say, negative profits, negative earnings after taxes. These decrease retained earnings. Okay, so just think of the words retained, which means kept, earnings, which are profits, profits that are kept. So if we keep that simple, if we have profits that are kept, then obviously it's going to go up. Dividends are going to, we're actually distributing the profits, and losses decrease retained earnings. Now, if I was going to put it into a formula, I'd say retained earnings equals the beginning retained earnings plus net profit minus dividends. Okay, so fairly simple formula there. And some of you are probably still at the point where you don't really terribly understand this, so I'm going to suggest you memorize that for the rest of the course as well. Sometimes memorization is the only way to go until you completely understand things, so go ahead and memorize. Okay, at year end, our ending accumulated depreciation or amortization for the year. So we start out January 1st, so the beginning depreciation amortization. We add in the amortization depreciation expense, and we get our ending accumulated depreciation amortization. So we take the original accumulated, add the expense, and we get our ending accumulated. And that's another good one to memorize. Typically doesn't get understood for a bit yet. Similarly, for balance sheet accounts, not income statement accounts, balance sheet accounts, our last year's ending cash is this year's beginning cash. So if we close the doors at noon on Friday, December 31st, and we go out and start having a good New Year's Eve sort of thing, nothing happens to our cash. Okay, at the end of the year, it's still there. We come in January 1st. Well, let's say we come in January 2nd. Actually, we'd come in on the Monday. Monday would be a holiday. So let's say Tuesday. We come in on the Tuesday. Nothing's happened to our cash. It's the same. The balance hasn't changed. So last year's ending is this year's beginning. Okay, very simple concept here. On the balance sheet, the end of the year balance sheet is the beginning of the year balance sheet. Okay, so all the accounts remain the same. The income statement, of course, gets changed because starts out or ends with all kinds of numbers on it. Then we start with a clean one, January 1st. Okay, ending retained earnings. Okay, so we've done our income statement. We've done all our calculations. The balance sheet shows at the year end our ending retained earnings. Tuesday afternoon or Tuesday morning when we go in, that's our beginning retained earnings. Okay. Accumulated amortization, same idea. Assets, loans, everything is exactly the same. So that's just something to think about. Okay, some key terms. Again, working capital. There are a few formulas for this one, but we're going to keep it simple. Working capital equals current assets minus current liabilities. Okay, looks a lot like the, what is it, the current ratio. Instead of a minus in there, the current ratio's got to divide. That just gives us an indicator of how much cash we've got kicking around available in surplus of our current liabilities. Capital cost allowance. Years ago, we had all kinds of things going on, and accountants, i.e. people like me, would take advantage of certain rules when it came to applying depreciation expense. So if my expenses increase, okay, think about that. What happens to my profits? If my expenses increase, my profits decrease. Now, Revenue Canada charges income tax. So if you have lower profits, you also pay lower income tax. So accountants were getting a little bit too aggressive with some of the things they're doing. So years and years ago, Revenue Canada and governments around the world decided to put in a list of rules. And they said, here's how you can depreciate or amortize things. And they didn't want to say depreciation or amortization, so they used something in Canada called capital cost allowance. It's just Revenue Canada's version of the same thing. And it uses declining balance method. It doesn't use straight line, uses declining balance. So that's something to think about. And we did a bit on that already. So also has the half-year rule for first year of purchase. And if you click on the link in the slides, you'll go directly to the Revenue Canada list of rates and rules. So that's kind of handy if you're trying to figure some things out for cash flow purposes and that sort of thing. Okay, so we're done our lectures for week 2. Have a run through the exercise. Do the assignment, put it in the Dropbox. And then we'll go through it virtually if you require, and we'll go from there. Week 3, we start to get a little more in-depth on things, and we start to get a little farther out in terms of review, in that some of the stuff is going to be completely brand new. So it gets a little tougher the next 3-4 weeks.